Okay, the majority of this lesson is going to deal with taxes. So that sounds like a lot of fun. So let's check it out and see what is involved when you have to file your taxes. First of all, income tax is the percentage of your income that the government collects so that it can fund services and programs. In other words, fund all the things that, like firefighters, police officers, all the things we need for our society. Let's determine taxable income. Okay, so to calculate your income tax, you start with your gross income. Now, gross income is what you make. Okay, so this is some of the things that includes wages, tips, interest or dividends from investments, unemployment compensation, profits from a business, rental income, and game show winnings if you've been on a game show recently. It does not matter whether the winnings are in cash or cars or whatever. You still have to claim them. Okay, now the next step. So we know what our gross income was. Okay, so that was our gross. Now we get to determine our adjusted gross income. So adjusted gross income is figured by subtracting allowable amounts. Okay, these are called adjustments. Okay. These are untaxed portions of the gross income, and here's what they include. Contributions to retirement accounts, tax-deferred saving plans, interest paid on student loans, and some self-employment costs. Those are a little tricky, but you can claim some of them. Now, in a tax-deferred retirement plan, keep in mind that you get to deduct the full amount of your contribution, but you will pay taxes on it later when you withdraw it. And the rates are a little bit higher if you withdraw it before you are of retirable age. Okay, let's look at this one. All right, so we have our adjusted gross income, or we had our gross income. Our adjusted gross income was this one. Now we're going to take that and subtract our adjustments, okay? So now a standard deduction is a lump sum, an amount that you can subtract from your adjusted gross income, okay? The IRS sets the amount, and most of the time, if you're young, you probably are better off taking the standard deduction because it's hard to get higher than that based on the deductions you're allowed. Now, here's some itemized deductions. Now, if you have any of these and they are more than the standard deduction, you're better off doing itemized, okay? So here's some that you can use. Let's see. Interest on home mortgages, state income tax, property taxes, charitable contributions, and medical expenses, but they have to exceed, and I should not have written over that, they have to exceed 7.5% of your adjusted gross income. So that's quite a bit. You have to multiply that out. So if you have some medical expenses, you got to make sure they're more than 7.5% or you can't claim them. Okay. And again, if you've itemized and it's more than your standard, you want to take the itemized deduction. Okay, so taxable income, what they actually tax you on is your adjusted gross income. Okay, so your gross income minus that tax deferred money, and then we take away the deductions. Okay, sometimes it's the standard deduction, sometimes you can do what we call itemized. That's your taxable income. So let's look at one. Angelo earned wages of $63,500. He received $1,850 in interest from a savings account, and he received $15,000 in winnings from a television game show. Okay, so all of this is money that he's going to have to count. Okay, now he contributed $7,800 to a tax-deferred savings plan, so he's going to get to take that off. Okay. Then let's look at this. He is entitled to a standard deduction. Okay, so that's a standard. Now, if he can get more itemized items than $12,550, he's going to want to itemize. So let's look and see what he has to itemize. The interest on his home mortgage, okay, that was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes, and he contributed $3,000 to a charity. So if all that adds up to more than the $12,550, then he's going to want to itemize. So let's look. First, let's figure out, go back to this color so we can kind of color code. Let's figure out his gross income. Okay, so that would be the money he earned plus the interest from savings plus the game show. So this is his gross income. Now we're going to do his adjusted gross income. Okay, so the adjusted gross income is minus those adjustments, which is that $7,800 he paid to the tax deferred savings plan. So now he's at $72,550. Now next, we're going to look at the adjustments he can make. Let's see what he can take off. Okay, so we have his adjusted gross income, and now we're going to see if he's got any deductions. Okay, so we want to determine his taxable income. He's entitled to $12,550. Okay, so let's look at what he can itemize. If he itemizes, we have the $6,500, the $2,100, the $1,855, and the $3,000 that he did to charity. That adds up to $13,455. Okay, all of those are more than the standard deduction, so he should itemize. And when you take his adjusted gross income and you subtract those deductions, this is called his taxable income. That is what he can be taxed on.